Bond guru Bill Gross is waving a gigantic red flag at the financial world right now. In his brand new investment letter just out, now, by the way, this thing is anticipated by thousands of investors out there. Janus Capital's Gross slams central banks and their attempts to stimulate markets. And here's what he said, quote, "The negative interest rates dominating 40% of the Euroland bond market and now migrating to Japan like the Zika virus will not generate economic growth. In fact, it will strike two sectors sicken them." So Bill says you need to avoid them like the plague. Let's bring him in right now. Janus Capital portfolio giant Bill Gross with us live. Bill, negative rate creep from Europe to now obviously Japan. You say it's going to inflict disaster. Where and how?
Well, in various historic business models, Liz, let's examine banks and insurance companies and pension funds and ultimately the household saver. If they can't earn enough money to pay for future liabilities or for expectations in terms of health care or education or retirement, then the economy basically sags. And that's what we're seeing in Japan. That's what we're beginning to see in Euroland, is that negative interest rates, which, hypothesized that the lower they go, the higher asset prices go and the economy basically recovers. It's becoming just the opposite because it robs the saver of the ability to earn money.
Well, I can tell you a lot of our investor viewers own the bank stocks. They own certainly these names that are out there, both European and American banks. You use the term collapse, but not it's going to collapse. You say it's already collapsed. Let's just drill down to that, because there's some people saying now is the time to get these because they look inexpensive.
Well, my point was not to pick on the banks in particular, but to suggest simply that lower interest rates, negative interest rates, and indeed what we call flat yield curves, that is a relatively tight spread between money market rates and 10-year treasuries, it's a negative for banks, and they wish that the spread was much higher. In other words, they wish that interest rates were higher because their margins are dependent upon a certain historic spread, and now banks are suffering because they themselves can't earn enough money. And so it's not a collapse, it's just a new model going forward in which financial institutions can't earn what they used to earn, and so the prices have to be adjusted to take that into consideration.
Who's at fault? You mentioned the term central bankers quite often in this note, which we find absolutely spot on, because they have been plumbing the depths, but they feel that this lies on their shoulders to fix this situation, because certainly here in the U.S., Congress isn't doing its part.
Yeah, and it's hard to fault them because history's on their side, and Janet Yellen and Ben Bernanke and Greenspan before them, all lowered interest rates when times were troubled, when markets were sinking. Ultimately, though, when you get down to zero or into the negative territory, it seems that the rules change. And like I say, the savers, the business-modeled companies such as insurance companies and banks and pension funds, ultimately they can't earn enough money to do well, and in some cases survive. And that's why Puerto Rico and Detroit and other entities are beginning to crumble, because they've overpromised, yes, but they've also underinvested in terms of their ability to earn benefit.
Well, sure. Now, you say that this Zika-like virus of zero rates is going to affect two sectors. One, you say the banks, and two, you say insurance giants. And you specifically name three of them. We can put them up on the screen, but you say they could very well be damaged because these insurers, quote, cannot cover claims as conveniently as they did in the past because of these low rates. So would you say, please stay away from these names?
Well, no, but just be cognizant that their ability to earn money and to grow earnings, it is impaired going forward. It doesn't mean that the Pru and the Met and Hartford and others are going under. They're not. They're very stable, strong companies in terms of balance sheets. But earnings going forward will be hampered. For instance, many of these insurance companies issue what are called variable annuities, in which they promise a certain return relative to the stock stock market, and when the stock market can't return historic levels, 8, 9, 10%, but can only return, let's say, 2, 3, or 4%, then their earnings suffer. And so just be cognizant that dividend increases and the earnings increases in these institutions is not going to be what it was 10, 20, 30 years ago.
Bill, we've got the Dow up about 41 points. The market looks like it's saying, at least at the moment, what me worried? Doesn't look too concerned, and yet we've got a huge political battle, and the arena has gotten more bloody. Certainly today, Mitt Romney coming out, speaking against Donald Trump. You've got a conservative political action committee with a $1.75 million ad buy to take on one of their so-called own, although they don't seem to want to take Donald Trump as their own. So they're almost eating their own here. Does this hurt the markets at some point?
Well, I think certainly if this continues going forward 3 or 6 months down the road, and the candidate in terms of the Republican convention is uncertain, so to speak. It's not a certainty that markets to a certain extent depend on. I would hope that the conversation becomes more intellectual as opposed to personal.
Yeah, I think a lot of us do. Can I just jump in and quickly ask you, if you hate the insurers or you're worried about the insurers and you're worried about the banks, where should people put their money right now with just a few minutes left before the closing bell rings?
Right. I think investors should, instead of lending money, should borrow money if interest rates are zero. And how do they do that? Do they go to the bank and borrow money? No. But they can buy certain closed-end funds on the stock market that yield 6, 7, or 8% that do borrow, to a certain extent, mildly levered, but borrow at 0 and 1% and allow the investor to earn 6 or 7% instead of 2 to 3%. So, closed-end funds. Example: BBN would be one, NBB would be another. These are BlackRock, Build America types of funds where the government is sort of guaranteeing the cash flow. So that's the way to do it.
Okay, Bill, it's great to see you. And by the way, we want to let people know this widely read letter. You can read it. We have been given approval to put it up on Facebook.com/Liz Clayman so that people can read. Bill, this is very poetic. It makes a lot of analogies to the dying sun. Bill, thank you. Great to see you. Bill Gross of Janus. Anytime.